Hi there, I'm Ernest Losper, investment specialist at PPS, and the views expressed in this show does not constitute as financial advice, however, is our own opinions. So in my line of work, what an investment specialist essentially is responsible for is assisting our financial advisors building their book, creating succession for their business as well, identifying opportunities, identifying gaps within their books as well, and ensuring those gaps are closed. So in essence, it's ensuring sustainability for their businesses. So one of the biggest is that everybody is essentially chasing returns. Whenever they're thinking about investments or saving, everybody's just thinking about the highest returns. But that isn't essentially what prudent investing comes to. What prudent investing comes to is ensuring that your financial goal is well sorted with a custom bespoke solution aligned accordingly. So that is the main thing, is essentially identifying a goal and ensuring that that goal has a well-fitted solution for, a bespoke solution for. So it's important for us to also understand the investment markets and the different asset classes that comes along with it. The reason for that is because there's a clear distinction between your growth assets and your stable income generating assets. Now, when you're looking at your growth assets more particularly, they provide high potential return for the long term, later in the future, retirement, etc., right? Whereas with your more stable income generating asset class, it provides you a safe haven for in the event that there is some turmoil in the market, God forbid another COVID or pandemic occurs, your money is safe. So what I'm trying to get to is, when you're looking at those two asset classes, it's not one or the other, but it's a perfect blend to ensure that we meet your need. So starting off on a clean slate, right? A young couple, young investors, practically starting off their journey. It is imperatively important for us to understand that it's not about the now, it's about the then. We don't want to be in a situation where you are retiring and 10 years go down the line and I need to either come out of retirement or I need to start a business of my own just to make ends meet. So ensuring that different aspects of your life is sorted for, compulsory aspects, long-term savings after retirement. When you're looking at a bit closer, midterm, I want to go on a vacation. I want to go on, or perhaps I'd like a fund for my child that's going to university or high school in the next couple of years. So now I need to invest according to that as well. But the point that I'm trying to make is, when you're starting off, we need to identify, and so it's not about us simply just putting product or just talking about product. It's about us understanding where you are in your life so that we can essentially partner up with you to ensure that your goals are achieved. The differences between those two, I'll first speak the differences between retirement annuity and your pension and your provident fund, right? On the left-hand side, we have our retirement annuities. That's essentially us voluntarily contributing towards our RA. So after we got our salary from our company, myself, I decided, okay, maybe I'm not saving enough via my provident or my pension fund. Let me open up another retirement vehicles via retirement annuity. Now, because that is entirely, there's no association to a firm, that is. So once you turn the legal age of 55, you can access that money without needing to resign from any employee, etc. Whereas a pension and a provident fund, that's what particularly speaks to the relationship between you and your employer. So therefore, I'm working at a company, at a said company, and some of these companies also, they offer a match. So if I'm willing to contribute 10% of my income towards a provident fund, they're willing to match me at that. So that's the main differences between your retirement annuity and your pension and your provident funds. So recently there has been some changes that has come along into legislation, whereby before when you would like to access your provident fund, you would have been able to access the entire lot of the fund, right? 100%. I'm going to spend my provident fund. But this has created a bit of a dilemma going forth for our government, whereby individuals take the funds that they've been saving towards and use that to cover debt, to essentially go on vacation. But what happens thereafter? That's the question, right? So hence why legislation has been amended, whereby the provident funds now acts as a pension fund, where you are compelled to implement a split when you go forth with your retirement. So that's essentially a high-level, brief overview of the difference between the three. Okay, so looking at the data out there, right? One of the biggest mistakes that they do is, at the end of the day, they follow trends that are set, right? With technology always developing and always going to the next step out there, information is readily available. So that means that our markets out there is highly efficient. So the point that I'm trying to make is that once you get notified of a specific trend happening, it most likely is too late, because it's either that that trend's lifespan has come to an end or is close to its end. Therefore, you're forfeiting the growth you would have gotten right in the beginning, right? So it's essentially not enough research that is being done in regards to what's happening out there. Secondly, young individuals allow noise and allow different sources of information to affect their decisions. Therefore, it is imperatively important that you sit down with your financial advisor, especially when there is turmoil, especially when your friend is telling you invest over here, invest over there, so that you can just realign yourself to your goals. And once you have done that and created that long sustainable business relationship with your financial advisor, no noise, no distractions or anything like that should deter you from your journey. So when it comes to relationships and your investments, etc., and whether or not you should protect it, it comes down to trust. It comes down to the relationship that you built with your spouse. On my side, I share my finances with my wife. I know exactly where I want to go, and I mean, it's a journey that you're embarking on together, not only through a romantic way, but also making sure that both of our finances and our investments are well aligned to meet both of our goals. So coming to the question where you mentioned, should you protect your finances from other people? Maybe, but however, not from your spouse. It's a journey that you guys should take on together. But moving on, if there is investments and there are assets that you have accumulated before marriage, your marriage agreement is going to be highly important, because that's going to stipulate what will happen in the event that, God forbid, there's a divorce in the family, how the funds will be allocated. You have your marrying community of property, which practically has one estate. Okay, in the event that you're just dating, it becomes a bit more tricky, that is, right? As you haven't yet embarked on that journey of, look, this is going to be my spouse for life, right? Views have changed as time progresses, where people are dating a bit longer, people do move in together, which does make things a lot more interesting going forth, right? However, it just comes down to that individual's comfortability, because you're not bound by any marriage contract, to basically disclose anything. So it's entirely up to what you as an individual feel comfortable with disclosing with your partner. It could be realigning themselves to their investment goals initially. When you're looking at historical figures, etc., there is a generally upward trend in the market. So when there is a market crash, that is, we have already taken the necessary steps beforehand to ensure that your funds are well diversified, that your funds are well taken care of, that safe haven of stable asset classes is carrying your investment throughout that time. But the thing is, what you don't want to do in this scenario is emotionally react to changes happening in the environment. Because what's going to happen then is, if the market is tumbling, right, most likely there are different sort of investment that's also tumbling, right? The market is tumbling holistically. However, if I decide to disinvest at any point in time while the market is tumbling, I'm solidifying that loss. Earlier, I mentioned that the market has a general upward trend. So wherever there's turmoil, there is an opportunity. We just need to be well grounded in what our goal is. For example, carrying on with the example, the markets are tumbling. Now, instead of disinvesting, wouldn't you see this as an opportunity to perhaps increase your exposure to growth assets at a lower price? So these are the sort of discussions that we will be embarking on, but it will definitely need to reestablish those goals, re-emphasize them, making sure that the client and the spouse is well sought for in the event of a market crash. I'll tell the younger version of myself, right? Still enjoy your university life. It is a time that you're growing up, you're building new relationships, you're starting your networking journey. A lot of people that you're going to be studying with, building relationships with at university, you're eventually going to work with, right? So what I'm saying is, don't put up such high walls and make it so restrictive for yourself to essentially enjoy your youth. You're only young once, and if you're expecting me to say, you know what, stay at home, save everything for the future, it's not going to, I'm going to disappoint you in that regard. Because we are still all human. We all also need that sort of human interaction and relationship building. And unfortunately, one needs to spend money when you get to that point. So what I'll tell my younger self is, enjoy your university lifestyle. Enjoy your friends, making friends, going out, but also do take that stance in regards to possibly starting that investment journey up front. Time is an invaluable asset to us. It's a thing that we can't get back time. So that being said, it's important for us to start the journey sooner than later. There's a concept in investments called compound growth. Right? Well, compound growth basically states that your growth is going to grow in the future with your investment. So the sooner I start with my journey, the better it is in the future. In actual fact, this reminds me of a scenario, right? We're running a few scenarios at work in regards to investing, etc., right? And an investor we ran a scenario where we took an investor starting by the age of 25, right, over a 40-year period, at a very assertive, aggressive return of approximately 10% for a period of 40 years in the future, at 1,000 Rand with a 10% growth on the debit order, right? That consistent payment that you are making now will essentially leading to an investment's future value of approximately 8 million Rand. And that is the power of compound growth that it has on you as an individual, on your future as well. So yeah, that's at the end of the day what I'll tell him. I'll tell him, go and enjoy your life, but maybe just save a little bit on the side. So the thing that I wish they told me before I embarked my career journey in investments is the fact that it's a marathon and not a sprint. Sacrifice your short-term satisfaction for that long-term goal at the end. Prudent investing, goal-based investing isn't a get-rich-quick scheme. It's a marathon that we're running. So that's exactly the feedback that I wish I've gotten when I started, that's a marathon, and while you are doing what you need to do to make a living, etc., you're allowing professionals to take care of your investment, that is.